Morning, everyone. We have got Scott on the line, Scott Smith with Barrett Financial, yeah?
Yes, sir.
Okay, sounds good. Scott has given us an update. Man, it's been a long time on mortgage and interest rates, and I just felt like there was a need to refresh all of ourselves in regards to this. So I wanted to basically hit the ground running, talking about interest rates and mortgages and all that good stuff there. So you were talking about, which was a little concerning to me, that mortgage rates have actually gone up more in the last month, you said?
Yes, absolutely. And I'm going to give you some specific examples on interest rates, but there's been a lot of conversation about the future of interest rates. And what we've seen these last 3 weeks is several reports that show the economy is stronger than expected. It's been very good for stocks, but it's been hard on bonds and mortgage rates, which is bonds drive mortgage rates. And the head of the Federal Reserve, Jerome Powell, was on 60 Minutes like 3-4 weeks ago saying, yes, we're going to cut interest rates, but he went on to say that probably not as much as Wall Street expects and probably not as soon. And that further, that the fiscal policy or the spending by the federal government was not sustainable, and it was a concern to him.
Right.
And then just like 2 weeks ago, one of the governors for the Federal Reserve gave a speech titled, "What's the Rush?" And his thesis was that we're in pretty good shape where interest rates are now, and there should be no rush to cut interest rates. So that, combined with the general economy and just tons of money being spent by the government, has lifted interest rates. And so I went and I looked at interest rates this morning to prepare for this call to give you guys some answers. And when we talk about interest rates, we need to put some disclaimers out there to be both accurate as well as compliant. So what I did for both the examples I'm going to share, I put together a $500,000 purchase price for somebody with excellent credit, like 780 or better, and for the conventional loan, making 5% down payment, and for an FHA or VA loan, making the minimum down payment. With FHA, that's 3.5%, and VA 0%.
Right.
So,
okay.
So for conventional loans, if we were going to do them with no lender fees, which is important to note, most lenders, direct lenders, charge anywhere from $1,400 to $1,800 in lender fees, and they call it processing, underwriting, administration, etc. I can pay all of that for the client. So right out of the gate, they save $1,400 to $1,800 in lender fees. And then depending on what strategy we wanted to use to get rates, they would be in a range of probably as low as 6.5% with higher closing costs, or as high as 7.25%, pretty close to 0 points. That's like 0.1 points today.
Yeah.
If they did want to pay a point on a conventional loan, we'd get them down around 6.99%. And so those are the conventional loans.
Well, you said 6.5 to 7.25, and if they buy down, they could only be 6.99. They can't. If you buy down, you can't go lower than 6.5 right now.
You actually could. You could get down to 6.5% for just under 2 points or 1.95 points, and you can get lower than that, but it doesn't make sense because we think we'll have lower interest rates, and if they pay very high closing costs, for example, 2 points, to get a lower rate today, they might not make up enough in monthly savings to recoup that for 3 or 4 years.
Yeah.
And if they have a chance to refinance in a year, they wasted that closing cost. Okay?
Yeah, that makes sense. Got it.
So to that point, Spencer, we're doing a lot of temporary buy downs, and a temporary buy down is where maybe for 1 year they have 1 year of lower interest rates. So let's say that they did a loan at 6.99% that cost a point. In year one, we might be at 5.99%, and then years 2 through 30, they could be fixed at 6.99%. But if they believe that interest rates are going lower, that's probably a much better strategy for them.
Right, that makes sense. Yeah, that's interesting. So how much have they gone up in the last 30 days because of the strong stocks, and which is not good for the mortgage, for the bonds and mortgage rates? How much have they actually gone up in the last 30 days?
3/8 to 0.5%, depending on the purchase price and different details like that.
Yeah. Okay. Wow.
And the FHA and VA rates are quite a bit lower. So let's touch base on that real quick. If you wanted to do a loan with no points, the lowest cost, you'd be right around 6.5%. if the client wanted to pay a point, they could get down to 5.99%.
Yeah.
And VA loans are in that same price range. And it's important to know that I work for one of the largest wholesale brokers, and our rates are traditionally 0.3% to 0.5% lower. So if you were talking to a lender that was not a broker and they lent their own money, they would either have significantly higher rates or the same rates would cost much more.
Makes sense. On remind me on VA and FHA. Is there a cap on a financial amount that you can spend?
Yeah, good question. So FHA, there's no cap on what you can spend. There is a cap on the loan amount. I don't have it in front of me, but I want to say it's $530,150. So you can go higher than that as a purchase price, but after your down payment, that's your maximum loan amount for FHA, and that's in most of Arizona, Maricopa County, Pinal County, et cetera.
Yeah.
VA used to have a cap, and it used to be the same as the conforming loan limit, which right now I want to say is around $766,000.
Right.
Again, from Maricopa and Pinal. But VA removed that cap a couple of years ago. I want to say maybe beginning of 2022. So
Right.
You can go as high as you want on VA, and it's as long as we're talking about rates, it's worth noting that VA and FHA are exceptional loans. And if you don't have a credit score of 720 or higher, and you've got a loan amount below $530,000, a lot of times FHA gives you a much lower payment because of the lower interest rate.
Right, that makes sense. Tell me, on FHA and VA, can you explain to us why the interest rates are lower as opposed to just going the traditional route if you go FHA?
Yeah, that's a good question, and it's something that's come up in the marketplace a lot. And the shortest answer is that they are backed by the federal government, so it's almost like they're subsidized. So if somebody does not perform on an FHA or a VA loan, the federal government guarantees that they will make the underwriter or the lender whole on that loan if there's a foreclosure. And historically, that's how it's been. I don't think that argument is very valid anymore since in the Great Recession of the 2008 to 2010 era, the Federal Housing Finance Authority was created, and they put Fannie Mae and Freddie Mac, the conforming lenders, under conservatorship, so you could make the same argument that they're federally backed. However, it's always been that way, where FHA and VA loans are approximately 0.5% lower.
Right. That's interesting. That's cool. Thank you for explaining that. Anything else on the top of your mind with the rates? I keep interrupting with questions.
No, that's okay. I'm glad you're asking questions. The one thing I would point out that came up in our conversation is a temporary buy down for lower interest rates makes a lot of sense in today's marketplace, and there's a lot of them out there. We can do a 1-year buy down, we can do a 2-year buy down, and then with those buy downs, they can either be temporarily lower by 1% per year or as much as 2% in the first year. And that's important in helping buyers move forward, because a lot of them are going from a mortgage of $200,000 with an interest rate of 2.75%. And now they're looking at a mortgage of $500,000 or $600,000 and a mortgage of 6.5% to 7%.
Right.
So the temporary buy down strategy can help get your buyer comfortable with moving forward. And another example of that is if you've got a renter who's paying $1,600 to $2,200 a month in rent and they want to buy, it can be a little daunting for anybody, let alone a first-time home buyer, to look at a payment of $2,800 to $3,000 a month. And temporary buy downs will help people save $200, $300, even $400 or $500 a month in the first year. And you have cost certainty for all 30 years because you know exactly what the rate will be. The goal is that interest rates will be lower and they'll have a chance to refinance. And the great part of temporary buy down is we get the seller to pay it with a seller concession. All of the savings that the buyer experiences is paid for by the seller. And all of the savings for the 1 or the 2-year buy down is held in an escrow account for the buyer. So if the buyer has a chance to refinance before they've used all that, that money in the escrow account goes towards the new loan.
Makes sense. Okay, makes sense. Tell me this. So I'm overall just making a statement. So as the economy shows and reports, like we've seen, like that it's doing good and the economy is well, as long as that's happening, the interest rates are most likely going to stay the same and not go down as long as these reports keep coming out pretty strong like they are, correct?
Yeah, that's the concern, and that's the message that Wall Street has now, which is that we're going to have higher interest rates for longer. And
right. So if we're hoping they get down to 3 in the next year or two, that's most likely stop hoping, right?
Yeah, absolutely not happening. Now, with that said, Fannie Mae and Freddie Mac have come out with some forecasts of where interest rates are going to be, and they've got predictions in the low 6s or early 5s this year. And I'm sorry, I said that wrong, in the low 6s or the high 5s as an interest rate range. And that would be a real positive, because I think that home buyers are starting to realize that housing prices are going to hold steady and or go up.
Right.
And that interest rates of 5 to 7% may be the new normal.
Right. And while I have the thought, I want to get on another call with you. I want you to go over what is Fannie Mae and Freddie Mac. I want to take note of that, and let's get on another call soon, maybe sooner than later. What is Fannie Mae and Freddie Mac? That term is always thrown around, and most people don't even have any clue or know what that is.
Yeah, that's a great point. So we'll talk about that again, and that's where all of the conforming conventional loans come.
Got it. That makes sense. We'll dig into that a little bit more. Well, that's good. You guys, as far as interest rates go, I mean, it's just one of those things. When we saw them at 1 or 2% years ago, I mean, it could have been a once-in-a-lifetime thing. We probably didn't recognize that or take advantage of it. But these little temporary buy-downs that he's talking about is just awesome. Scott with Barrett Financial is the place to go. He is my preferred lender, and Gentry and all my brokerages' preferred lender. I would strongly suggest, if you are going to be buying a loan or if you have family or friends, getting them over to Scott. Just text me. I'll send you his cell phone. You can have his cell phone and reach out to him. So, Scott, I appreciate you getting back on the call, and let's do it again and talk a little bit about Fannie Mae, Freddie Mac, and dig in there.
Fantastic. Thanks so much, Spencer. We'll talk soon.
Okay, thank you. You guys have a great day. Thank you. Bye.